All right, guys. Fed any minute now is going to announce what they're going to do here for the next little bit. But what are your general thoughts on where we are in the market today?
It's a little bit more of the same. I hate the term uncertainty in markets because there's always uncertainty. But I think this is one where you literally have some variation of actions by people that can make the market, or at least the attractiveness of different parts of the market, go in different ways. And so I think it's really interesting time frame so far, but it's thrown up a bunch of opportunities as well for us.
What about you, Chris?
It's interesting that April, if you look at it on paper, month-to-date numbers don't look like anything happened. And obviously we know, as having lived through it, that the S&P, the Russell, any of the indexes that you might have been looking at had 10 to 15 point swings, intra-month. I think the S&P finished down 1. Mm-hmm. So it doesn't look like anything's going on. At the same time, you still have a pretty big dispersion of asset classes so far year to date that we hadn't seen, or we didn't see as much of last year. I think small caps are down 11 or so, and S&P's down 4, and so things like that we're starting to dig into now on the investment side.
Yeah, the most important thing I saw was in April when we announced the tariffs, and you looked at asset flows. I think you can back into this, but you really had the US dollar weakening, the S&P 500 weakening, and treasury yields going down, where the German bond, the German risk-free bond, was actually appreciating. And generally, European equities held up well. I think they were up 10% through Q1 or something like that. So it is giving you a signal that assets are moving out of the US internationally, which is a reversal of what's happened in the last 10 years. I think that's really interesting. Who knows if it persists or not, but that would mean that would have some interesting implications for the next few years.
Yeah, it feels like I think that at two levels we're seeing some shifting, right? We're seeing things like value outperform growth, international outperform domestic. So there's sort of I won't call it a micro level, but there's sort of at that level we're seeing some things shift and different performance from different asset classes than we've seen maybe for the last 4 or 5 years. And then there's also this sort of macro, like, is the world really changing? Like, is the world shifting in the way we think about the world? So are asset flows now, is the U.S. going to be a less desirable destination for asset flows going forward than maybe the last decade? So maybe comment on those two sort of shifts that we're seeing. One that's more, what I would call like at a micro level, and then one that's more of a macro level.
You want to take the micro? I'll do the macro.
Sure. I think in the micro, if you're looking at specific assets and what's happening, there's a very long story that's playing out in the private world. Real estate's an easy example where there were a lot of deals that were maybe questionable that got done, 2021, 2022, and banks are pretty jittery because they understand that maybe the asset's not worth what it was when they underwrote it. And these aren't things that happen in days or weeks or even months. They play out over months and years. And so we're seeing some much more interesting distressed opportunities in stuff like that. Whereas you look at the market, as we just discussed, and it's, things can be wildly different, week over week. And so I think there's this micro backdrop of interesting assets potentially coming to market and interesting things to do on the private side, where the public markets seem like it's either rosy picture or panic on any given day.
Yeah, and we were out in London. I think Chris was there too with a couple of investment team members, and we got a pretty good sense of the dynamic that Chris was talking about. There's a French philosopher, I think Henri Bergson is how you pronounce his name. I think if I'm pronouncing it right, because it's French. But it's basically the eye can see only what the mind is prepared to comprehend. Mm-hmm. And I think the shifts that you're seeing are really interesting because on the one hand, we're trying to say, big picture, we're going to reduce our deficits. Well, that means fewer US dollars in circulation. Part of the reason why the US is the reserve currency of the world is because we run deficits, because you need to have dollars in circulation. So to the extent that you are trying to change the dynamic and there'll be fewer dollars in the system, That creates market panics. Like every time you go to 2020 or 2007, you will always hear about dollar shortages. And so it's almost counterintuitive as to what we are trying to do in terms of maintaining the reserve currency status. So there's some very interesting, I think, interplays there. And I think that's part of the reason why the dollar is weakened, because if you're going to run a more balanced trading system, then there's going to be less need for US dollars for foreigners. And so why would they keep holding on to US assets when they don't need to, because they'll have fewer US dollars? And so you're seeing this flow back from the US to Swiss franc to Japanese yen. I think we've always been valuation focused. So we've had an allocation to international assets. But in this case now, this provides, so it's cheaper, which we like, but also has a tailwind now because markets are kind of supporting us in terms of what some of those assets are doing. And so this could be like a 3-month thing, or it could be like a 10-year thing. It's hard to say.
Yeah. So how would you handicap whether it's a 3-month or a 10-year thing? Like how much of it is current administration and policy, and how much of it is just a permanent shift in how the world thinks about things?
Well, something about this is permanent, because let's put the tariff part aside and think about all the stuff that's happening with NATO and defense spending.
Mm-hmm.
So this is, again, really interesting. So US has a really high budget deficit and debt, and we've kind of run out of capability and capacity to kind of support our companies and support spending. If you go to Europe, they've been very disciplined. And so their debt to GDP, let's say in Germany, is like 60%. So now, because they're supposed to spend more on their defense, they're going to run much higher budget deficits than they have done. So there's going to be more spending in Europe. So what the US was 10 years ago is probably what's going to happen in Europe. That creates an opportunity. I think things that, like from a defense perspective, are probably permanent. But it's kind of really hard to shift supply chains. It takes 10 years to build certain factories and parts and bring them to the US. So my sense is it'll probably normalize to some extent, but we'll just have to track and see in terms of what it looks like. Part of it's going to be what trade deals we strike, what's the tariff level, and all that.
Mm-hmm. So one of the things I appreciate about the way we do things at True North is, there is so much noise in the short run, right? Like every day there's a new headline, every week, every month there's something to react to. And, our posture and philosophy has always been this sort of value-driven approach. Talk for a minute about, in the midst of all this chaos, and I think with the new administration and all the policy changes, there's maybe a little more chaos than there has been over the last couple of years anyways. Let's talk a little bit about how we think about it from a portfolio management and portfolio construction perspective. Are we out making, big changes right now based on everything that's happening, or, how do we think about, kind of our long-term posture and the way we've always done things?
Yeah, I'll maybe start it off and Chris can comment on that. We want to be sure that we are ahead of the curve and not react to things. And so our positioning basically before this happened was we were immensely prepared in our portfolios for anything like this to happen. We love the concept of free optionality, which basically means that you're getting something for cheap, but if things turn in your favor, you get a free tailwind. So gold was a good example of that. We were buying gold miners at 5 to 7 times cash flow. Valuation was great. And that was in a zero inflationary period. I mean, there was a little bit in 2022, but this is a longer story. So if you get inflation now on top of that compared to what we're seeing, that like turbocharges your return. So in terms of just how we think about it, there are 2 levels. One's changes we make, the others the changes our managers make. So managers are moving and shifting their portfolios to some extent, and we are looking for that big swing, big hit, something that's a lower risk, higher return type potential. We are thinking of some of those things in the private markets that Chris can probably allude to and talk about. But we are very open to those opportunities, but we want to be offensive, not defensive. And I know Chris has worked pretty hard on some of those private opportunities.
No, I think that makes perfect sense. And then on the private side, again, it's not something that just changes overnight. But I think one of the things that we took advantage of in the zero interest rate environment was recognizing that, hey, we're going to have to take some risk on the equity side to do better in this environment over time because you're not getting paid for fixed income. Well, that's changed a lot. And so one of the knock-on effects from that is that if you look back 10 years and every track record that you see today from every large private equity fund out there looks stellar. Well, that's because not solely, but largely because they were levering up all of these businesses at very low rates, and multiples have gone up and up and up. And so if you look at the average private equity multiple that was paid between 2019 and call it end of 2022, it's like 12 times, give or take, earnings. And well, that's what the Russell 2000 is trading at effectively right now. So it stands to reason that you're not going to continue to see multiple expansion in the large cap private equity world. And so I would be we are very cautious about that right now. Private equity firms as a whole, there was a good article in the Wall Street Journal about 3 weeks ago that showed that their dry powder versus their existing holdings is at all-time lows right now, approaching 30%. And so the money to keep recapping these $100 million EBITDA, $200 million EBITDA businesses for ever greater multiples is not there. And the debt is costing them a lot more. So there's been a big wealth transfer and I think there will be over the next 5 to 8 years, a big wealth transfer from the private equity investors to the debt investors. And you may look back in 5 to 7 years and say, well, there's a whole generation of PE funds that basically made 5% or 10%, whereas everybody's track record now looks like 15 or 20. So those are things that are we're trying to be really mindful of. And so let's think about how to invest in the lower middle market of private equity, and maybe try to create businesses at 6 or 7 times, which is what used to be the number industry wide, or other asset classes.
Yeah. And there's been capital raised, like Chris said, and the larger guys are still raising capital. But if we are operating here in terms of size, when these companies mature, they become ready acquisitions for these bigger guys that are holding capital. So we don't need to access the public markets to be successful. We just need some capital above us in the capital table or in the size segmentation to kind of be successful.
Let's talk about a couple things in the portfolio that were put in place, months, maybe even years ago, that performed really well. You cited gold a second ago, but let's just talk about a couple things that worked really well that were they weren't a reaction to what happened the last 6 weeks.
Right.
These were things that we identified, months and again, maybe years ago, to put into the portfolio to provide that defensiveness in a really challenging environment.
Yeah, I think the interesting thing too, Scott, is that it's hard to point to one or two names that just carried the day. We got consistently decent performance overall from most of our positions, which was very interesting. And that's what you hopefully want to see. So we have been invested in midstream pipelines, for example, for a period of time. I feel like it was a no-brainer when we did it. I think it's fair valued now.
Yeah.
So it's appreciated and it's done really well for us, 30% type IRRs. But it's getting there in terms of fair and so that performed well for us. We've also been invested in small cap, to Chris's point, smaller names internationally. That's ended up doing really well. It's more resource oriented, but really pretty diversified, more EM, pretty small cap type companies that small cap from a US perspective, but still global leaders in what they're trying to do. And so that's worked really well for us. Some of the numbers on the private side have not yet come in, so it's hard to comment on all of those, but we've gotten good distributions and good outcomes on some of the venture deals we've done in the past. I just got an email yesterday on a 50x on a small position in a private partnership. So a lot of this, we planted the seeds of this maybe 5 years ago. We're looking to plant the seeds for the next 5 years when there's a dislocation.
Anything that stands out for you, Chris, that just kind of performed really well over the last 6-8 weeks that you thought, wow, I'm glad we have that in the portfolio?
Well, yeah, I think Dhruv hit it. Metals and mining and MLPs and some of those things did very well. But We also had very little high yield bond exposure
That's right.
coming into March, and those spreads gapped out pretty rapidly March and early April. And they've actually snapped back some since. But in general, our credit portfolio has been very conservative because spreads have been very tight, both in bonds and then also levered loans. And so I think there's a time when you can look at an asset class and say, this is less attractive right now, let's do other things. And that continues to be the case. I mean, we thought maybe, if spreads had continued to widen in April before the Trump U-turn on tariffs, then maybe we'd be looking at them right now and saying it's time to add. But that's okay. We're happy to wait.
Yeah, sometimes it's not what you own, but what you don't own that also helps you.
That's
which
right.
is the case here.
Clients often, when the market's selling off, in big percentages on a given day, the call comes in and it's like, okay, what do I do now? Like, well, what should I do? And often my advice is, well, everything we needed to do, we've already done. Right. Like we did that months ago. How would you react to that same phone call?
That's exactly right. I think I always like to say, look, if you're reacting to an event, then you're already too late.
Right.
So it's trying to be proactive, and that allows us to be offensive, to be able to react, because it's a little bit not just point dependent, but also path dependent, where you've been and how much risk you can take. So that's allowed us to be offensive. To Chris's point, there's not been a really big dislocation, but there probably will be at some time. There always is.
Yeah.
And I think because we try to keep our clients hopefully informed along the way, they really do buy into our philosophy and understand what we're trying to do. So those calls don't happen as much as, maybe 10 years ago.
Yeah. Chris, you see it any different?
No, I think that's right. I mean, I probably got 4 or 5 client calls that got to me over the course of the first half of April, and all of them were of the line of questioning, like, hey, is there something good that we need to be buying?
Yeah.
And as opposed to, do we need to be selling, or any kind of panic? And I think that speaks well to the messaging that we've had and what the investment team has done, because every client is going to tend to be looking at their accounts in times like that and saying, okay, the news is telling me the S&P is down 15. What does it look like? And if they're down 3, then that feels pretty good.
Yeah. Well, and to your point, Dhruv, if the S&P is down 15 and they're down 3 or down a point or 2, then they have the willpower to be offensive.
Right.
If they're down 15, like the natural human reaction is to pull back a little bit. But if the market's down and they're kind of holding steady, then you're like, okay, I can be offensive here.
Right. If you're selling at down 15 or down 20 and buying in at that point really is a function of how you feel emotionally. That's very well said.
Right. So let's one final thought here, and then we'll wrap up. So given that, like, what are we repositioning to today? What are the things that we're kind of looking at to reposition into right now to be defensive for the future or opportunistic for the future?
Couple of things I'd say. I think Chris has been very focused on real estate and some distress that's coming there. Basically, all the banks, if you looked at smaller banks over the last 5-6 years, they've made a lot of loans. Maybe to office because energy was out of favor. I'll actually let Chris talk about this. He's done more work on this than I have.
Well, we invested with a distressed fund at the end of the year, beginning of this year, that is basically picking up land from developers who are themselves distressed because they might have done 3 or 4 deals in the 21, 22, 23 time frame that might have initially had floating rate debt on them, and then now their interest rate has gone from 5 to 10, and the project is not doing as well as they thought, and so you need to get some liquidity to hold on to the deals that you've got, and so potentially picking up land at 50 cents on the dollar versus what it would have looked like prior to rates moving up. That's a very opportunistic investment for us, and partnering in this particular case with a group that's done this for a long time. That happens to be Hanover. Brant was on our podcast a while back, and so they actually just closed their fund today, I believe, and at the hard cap, and are finding some really interesting land opportunities. So that's something that we started looking at and call it beginning of 24, as we knew things were falling apart a little bit in the real estate development world. and are now poised to take advantage. I think there are already 3 properties in the fund that have been purchased at distressed prices, and hopefully that plays out over the next few years. And maybe on the private equity side, I think overall we've avoided the buyout world a little bit as we saw multiples were extremely high. And we had more asset classes that were what I'll call an esoteric or uncorrelated type things on the private side, like aviation leasing or litigation finance or different things like that. Right now, multiples are starting to come down a little bit in the private equity world. So that's the flip side of that is I probably wouldn't want to own a big PE portfolio that was bought in 2021, 2022, but of small companies that are for sale today or next year that may be really interesting for us.
I'll just cap it off with one last thing, which we've been so heavily invested in energy over the last few years, I think because the opportunity was great. And we started to pull back a little bit. But now oil prices are back at 57, 58, which may create some opportunity for us because you're able to underwrite some of those things at a lower price and potentially get to 20% type IRRs. So I'll just weave in also, there's oil that's down at 57, and then there's natural gas that's trading around $4. So what's really interesting is if you look at all these large, like the Metas of the world, the hyperscalers on the AI side, they need power to run their data centers. We heard from our manager through a conference, etc., that they've reached out to utilities to connect, and utilities are turning them down because it can impact the overall load profile of sort of their areas. So they are now reaching out directly to create some power sources, which if you think about Marcellus Shale, which is isolated a little bit because it doesn't have too many pipelines, you could potentially create a data center close to it by building a power plant right next to where the oil field is and supply data from there. So those opportunities in gas are coming up in terms of AI. There's also really interesting dynamic. If you look at natural gas, it's trading at $13 in Asia and Europe. It's trading at $4 here. So this is what, mind cannot see or whatever, brain can't comprehend, the philosophy stuff. And so could it be the case that if there is some shrinkage of supply and we start to export a lot of natural gas externally at a price of 13, maybe it's 10, does it mean U.S. natural gas prices rise to 6, 7, 8, which I don't think anyone's thought about.
Yeah.
So we are positioned that way. We're going to make money if things stay as is, but we could probably do a lot better if some of those things happen.
Great. Guys, thank you. I appreciate your thoughts, and thanks for taking a few minutes to join me today.
Thank you.
Thanks.